See, we have already discussed about the risk management, like in various, like risk is something which is uh, like uh, which doesn't leave any organization. Okay, so in particular, we are discussing about banking sector right now, banking organizations. So you know what are banks, correct?
Mm. Mm.
Banks are nothing but some institutions which lend money, okay, and
Okay.
they also borrow money. They lend money to the needy and they borrow money from the surplus people, correct? So this
Right.
is a bank. They borrow money from people by giving less interest, and they lend this money to the needy, okay, like they take in the form of deposits, okay, it's borrowing for them, and they like lend it in the form of loans.
Correct.
They pay less interest here, let's say 5%, and they charge like let's say 10%. Now home loan 9.7, 10% is going on like that right now. Okay, the
Right.
people who have taken at a very lower rate are paying a very higher rate right now. Okay, so
Yeah.
that is the case right now. Yeah. So the banks make money in this way. The difference here you can see 5 and 10%. The differential is 5%. So this 5% is banks earning. Am I right? In the sense they
Yes.
have to reduce all the cost, and also in general terms we can say bank is earning this differential. Now
True.
what kind of risk a bank may have? Of course we have already discussed about that: credit risk, default risk, and various
Yes.
other risks even. Okay. So now
Correct.
we are going to see about the risk measurement in banks. Like any other country, banks are in business of, sorry, like any other company, banks are in the business of making money. Of
Correct.
course, we have seen how they make money, and in the process they must take on varying degrees of risk. See, if you want to make money you have to take risk. Unlike other companies, our banks are also charged with protecting the money of their depositors, of course, many of whom have entrusted their life savings to the institution, and as a result are prone to be risk averse. Okay, what do you mean
Correct.
by risk averse? The one who doesn't want to take that much of risk, correct?
Right.
There are three types of you see three types of people. One are risk seekers who want to take high risk. One are uh, like you know like one are risk averse, who doesn't want to take that much of risk. Okay, okay,
Okay. Okay.
who doesn't want to take that much of risk. That's the reason why they deposit their money in banks instead of investing it anywhere else. They can take a
Okay.
land, they can take property or whatever, but they think that it is very risky for them to take all this. So they are okay with depositing their money in bank for 4% interest. And third category of people are risk neutral. Who are risk neutral? The ones who it doesn't matter for them whether
Correct.
they take high
Mm.
risk or low risk. Okay, so
Yeah.
risk averse people, they deposit their money in the bank rather than investing elsewhere. See, in the US, bank deposits are insured. You know, in US, the deposits are insured. You know, and
Mm-hmm.
if there is a default from the bank or bank is not paying the money to you, the insurance company has to make the payments to you. Okay, so they are not
Right.
scared of the banks running away with money, or any scam happens or any fraud happens, so they lose their money. It's unlike in India. Only I think 1 lakh was the, if you have 20 lakhs in bank and there's a scam in the bank, and
Mm-hmm.
bank has lost the entire money, it has become bankrupt now. So
Mm-hmm.
whatever it is, like 5 lakhs coverage in India they give, but in US, in UK and all countries they give you 100% money. It's the government's responsibility to get it done. Okay, for that they are charging, they are insuring your money. Understood?
Right.
So there is less risk. So because they are assuming much of the risk, depositors risk, the regulators require banks to maintain adequate capital. That's what.
Correct.
Since people are put like depositing their money in the bank, so the regulators, the apex institutions or the Securities Exchange Commission, they want some guarantee, some adequate capital bank should always maintain with them. Correct?
Right.
Now, so depositors are like depositing their money in the bank, and their money is at high risk. So the regulators want the banks to maintain some adequate capital. So what is this capital adequacy? It's a measurement used by bank regulators to assess whether a bank has sufficient capital compared to its liabilities.
Correct.
So
Mm-hmm.
suppose I have to pay 10 lakh rupees. So what is that I have? How much funds I have? Like
10. Mm.
in comparison to the liabilities what I have, correct?
Right.
So that means if I have a debt and equity, if my debt is 10 lakhs, my total assets may be 20 lakhs, so my equity will be 10 lakhs. So I have 50% debt, 50% equity, correct or wrong?
Correct. Mm-hmm.
So just as expected losses and unexpected losses are part of risk management for all businesses, banks also determine levels of expected losses in the form of borrower defaults on loans and losses on other assets. So bank also always does the assessment like what are the losses they have. So banks
Okay.
manage their expected loan losses by pricing their loans to cover some losses, and also by setting aside from profits allowances for loan losses. So what banks do, whenever they know that they are going to incur some loss, they try to losses by pricing their loans to cover some losses. That means they know already that they have a risk, so they try to take higher interest, okay, or
Right.
some amount they
That's
keep as
fine.
allowance, like every business has allowance for bad debts. In the same
Right.
way, from profit some amount is kept aside for any kind of loan losses, to set off any kind of loan losses. Now, unexpected losses are losses that exceed the expected level, correct? Bank
Yeah.
capital provides a buffer to protect the holders of bank's liabilities, that is depositors and its debt holders. So if bank keeps some capital with it, some kind of buffer with it, some funds with it, so that whenever there is a loss of such kind, unexpected loss, whereby some very big amount has been lost by the bank due to some default by some like borrower, so
Mm-hmm.
then, if bank has adequate capital, they can pay off. They can easily settle their liabilities. Am I right?
Yes, sir.
And in that case, the liabilities to bank are nothing but the depositors' money. So the depositors or the people who have amount in the bank, they're they are protected, isn't it so? Now,
Correct.
against the losses that exceed the expected levels. Thus, a bank must maintain sufficient capital to avoid insolvency in the event of unexpected loan losses. Now, bank regulators in most country monitor banks. Like in India also we have RBI and the
Yeah.
SEBI. In US they have their apex institution, and they have their stock exchange commission. The classification of banks capital account is standardized by banking regulators, so they will say you what kind of capital, how you should have the cap, like what kind of capital adequacy is what they will define for you. So international
Okay.
standards for bank capital adequacy have been developed and influence each country's regulatory requirements with respect to their bank's capital. The Basel Committee. Basel is a place in Switzerland whereby the this Basel Committee is formed, whereby this all the bankers and central bankers they meet, okay, and
Okay.
they do a lot of discussion, and they like what discussions are nothing but to protect the financial sector, okay.
Okay.
So the Basel Accord or the agreement has now been replaced by a more complex capital adequacy measurement system known as Basel 2, Basel 3 is in the process of being implemented. So these accords, one accord, accord 2, accord 3, meetings and agreements. So now they have this Basel 2 and Basel 3. Okay. So
Okay.
at present, implementation is scheduled for 2019. So I think the Hawk has not updated that. So, but 2020 was the pandemic year, and that year many things got disrupted. So I think still they are yet to uh, implement this Basel 3, okay, norms. So according to Basel Accords, capital is measured in different ways. The terms Tier 1 capital and Tier 2 capital are used to assess banks' capital adequacy. If the banks maintain these two types of capital, that means they have adequacy. Okay.
Right.
Now, how to
Right.
maintain this two? That has been mentioned. So So Tier 1 capital and Tier 2 capital are used to determine banks' required reserves. Now, what is this Tier 1 capital and Tier 2 capital all about? So Tier 1 capital is the bank's core capital, considered to be most reliable form of capital. So regulators use Tier 1 capital as the measure of bank's financial strength. Tier 1 capital is generally a bank's common stock accounts, retained earnings. Okay, understood?
Yeah.
So these are the most reliable ones. What is that? They have arranged the money by selling the stocks of their company and retained earnings. What they have retained the profits. So Tier 1 capital also includes perpetual preferred stock if it is non-redeemable and non-cumulative. So see, preference shares are of various kinds. So here the preference share, what they are speaking is about non-redeemable, whereby the money should not be given back. Okay.
Mm-hmm.
So if these
Yeah.
three you see, that comes under Tier 1 capital. Then Tier 2 is nothing but the other ones, like some kind of undisclosed reserves. What kind of reserve is, they don't say. Revaluation reserves, okay, and general provisions, general loan loss reserves, hybrid debt capital instruments. Like they are speaking about debt also right now, correct? So
Correct.
debt comes under Tier 2, apart from all these reserves which I have mentioned you. Okay.
Okay.
Now, although Tier 2 capital is including capital in calculating a bank's capital adequacy, it is not as reliable as Tier 1 capital. So Tier 1 is the most important and most secured kind of thing for banks. Tier 2
Okay.
is not that secured. Okay,
Okay.
just a second, Suma. Therefore, bank regulators usually place limits on the items and amounts of Tier 2 capital that can be counted toward a bank's capital requirement. Now, capital adequacy ratio is an international standard that regulatory authorities use to monitor banks in order to protect the bank's depositors. So this is what is the standard actually, that regulatory authorities use to monitor. See, every regulatory authority will monitor the banks, na? So they want
Yeah.
they want to know the capital adequacy ratio of bank,
Okay.
so that they may be confirmed about the depositors' money. So capital adequacy ratio measures the degree to which a bank can cover its obligations. Okay, if I have a liability of 1 lakh and if I have resources of 10 lakhs, that means I have at least 10 times capacity to make the payment. Na?
Correct.
Okay, so that is what is capital adequacy ratio. So just a second, just 1 second. Give me a
Yes.
second time. So a high ratio indicates that a bank is well capitalized and healthy, whereas a low ratio suggests that a bank is dangerously overextended and engaged in too many risky ventures. Okay.
Yeah.
So here the ratio is high. If I keep it 1 by 5, then 1 by
Then
5
it
is
is
what?
low.
Yeah. So it is like if I take in percentage, it is no. Just a second. High ratio. This is not ratio. This is a fraction. Sorry. So if I say whether like capital measures the degree to which a bank can cover its obligations. A high ratio indicates bank is well capitalized and healthy. So suppose if I have 10 lakh rupees of capital and my liability is like 1 lakh, so I have 10 times the funds, correct?
Correct, sir.
It's 5 by 1, it is less. So a higher ratio shows bank has enough funds and lower ratio suggests bank has less funds, correct?
Yes. Yes.
They have given the formula. Tier 1, Tier 2 capital, whatever the funds or resources they have divided by their weighted assets. Whatever the Risk weighted assets are nothing but the assets on which they think they have risk, whether the payments will come or not. Okay,
Correct.
that's what. Yeah, just a second. So risk weighted assets, now we will define what is this, and that will absolutely wind up the chapter. Okay.
Okay, sir.
So what is this risk weighted assets? Risk weighted assets is an adjusted total assets figure based on the premise that the assets have different risk profiles. Correct?
Right.
So the profiles have been given. These are all the assets based upon their risk. See, government debt, no risk. Consumer
Mm-hmm.
debt. So government debt is what actually? US Treasury securities. So we will come to that, no problem. So bank's assets are its loans outstanding. So you already know that banks, for bank the assets is loans outstanding, correct? What they are supposed to receive,
Correct.
and
Correct.
investments is what they do in the debt securities, correct?
Correct, sir.
So we will take all those assets. If the bank has invested in US government securities, 0% risk. If they have given the debt to debt on the credit card basis, auto loans, it's a high risk, correct? So the
Yeah.
risk is very high.
Hi.
Very high in the sense now the risk would increase. Commercial loans and commercial real estate, somewhat more risk. So you
Correct.
take the risk factor, R% of that, into the loan amount, into the assets value. Suppose the risk here is 0%. 0% into, if you have invested 1 lakh. So 0 plus, if you take this credit card, it has 10% risk, let's say. See, they did not define it. Okay.
Mm-hmm. Mm-hmm.
But I'm just taking a like hypothetical figure into, let's say, 2 lakhs. So if you take this, you'll get the risk weighted assets value. Am I right?
Correct.
Then past loans, due loans receive a higher risk weighting than others. Then low quality, below investment grade corporate debt, this much risk weighting, the riskiest one. Then some off balance sheet assets such as derivatives and all in determination of bank risk weighted assets as well. The risk weighted assets, the risk weights for off balance sheet assets are determined in two-step process. The financial institution first converts the off balance sheet item. See, off balance sheet is something which you don't show in the balance sheet, but still it's an
Okay.
asset for you, correct? Like
Right.
like if you take some
Mm-hmm.
property on lease, and the lease is not the capital or finance lease, it's a short term lease. Okay,
Okay.
there are two types of lease, na, capital lease and short term lease, correct?
Right. Yeah.
Speaking about short term lease, whereby you don't show in the balance sheet. So all those things you are taking. So first you have to convert those off balance sheet item into on balance sheet credit equivalent. That means if you have an off balance sheet item, if it would have been an on balance sheet item which you would have shown in the balance sheet, then what kind of ratings it, what kind of risk it would have had. So those things are not there because those conversion factors and all is not there in your syllabus. Let me be very clear, that much
Okay.
details they have not given in your syllabus. So the institution then risk weights the credit equivalent amount in accordance with the rules used for on balance sheet assets and includes it in the risk weighted assets. So that much detail is not given to you. So in this way you can find out the capital adequacy ratio. Okay, so
Okay.
like I'll see whether there's some practical question. If it is there, we'll solve one.
Sure.
So risk weighted assets, in the sense the risk weightage is given by some institutions, like how much you have to give the risk and rating. So it differs from country to country.
Okay.
I'm just taking some example. Just post a link here and we'll discuss. So here they have given good example, tier 1 capital, tier 2 capital. We have seen that. We'll do a question and the formula is here. Okay.
Okay.
There is a question given in this.
Tier 1 capital plus tier 2 capital.
Let us understand the capital adequacy ratio of an arbitrary bank. To understand, calculate the ratio for banks, we need to assume the bank's tier 1 and tier 2 capital. For calculating the capital adequacy ratio, we also need to consider the risk associated with its assets. Those risk weighted assets are credit risk weighted, market risk weighted. So there are a lot of risks, na? Credit risk, market risk, and all. So like that, they have given the weightages, correct?
Okay.
So assets
148.
value have been given. Tier 1 capital has been given, tier 2 capital has been given, and the weighted assets. That means they did the weighting and they have put the values. Understood?
Right.
That they directly added those values. Okay. And they got it 1720, and they have this capital also 148 and 57. That is like they added this 140 and 57 and they divided by 1720. So the capital adequacy ratio is 11.9%. Okay.
So they have divided. Can you
We've added
repeat
this
it?
tier 1, tier 2 capital total by
Okay.
the risk weighted assets. The risk weighting, how to do and all, it's a lengthy process. So they directly took the figures and they are showing it. Just for understanding purpose, we can understand, na?
Right, right. Okay.
And they have 11.9% capital adequacy ratio. That means that's pretty high and is optimal to cover the risk. It varies in the books of its asset. That means they have good amount of capacity to what? They have good amount of capital
To take a risk.
to like in the sense protect their depositors' money. Correct.
Okay.
That's what is the capital adequacy they should have, no?
Yeah.
Again, this link has one more question, so you can do that question as a homework. So cap 13%. Okay, 2-3 questions they have given, Suman. You can work out that one. Will you do
Link.
that, or
Yes,
you want
sir.
me to explain?
No, I will do it, sir. I'll do it
Yeah,
after
that's very
some time.
simply like understood thing. You can do that. So
Okay.
we are done with the risk management chapter. We are done with this. Now only the questions are left over. We'll do in the next class. Okay.
Okay, sir. ठीक है.
Okay, Suman. Then tomorrow I'll come with the questions from international finance. First we'll do that. Then we'll go with this.
ठीक है, sir. Done.
Okay, Suman. Thank you.
Thank you.